Welcome to the Deep Dive. This is where we take that pile of sources you've given us, articles, investor notes, YouTube clips, you name it, and we try to pull out the absolute core insights, the stuff that really matters, specifically for you, our listener.
That's the goal.
And today, we're jumping into an industry that, let's be honest, probably doesn't sound very exciting to most people. Coal.
Yeah, definitely not the sexiest topic on the surface.
Right. It sounds almost like something from another century. But wait a second. Because when you start looking at it, especially through, say, a deep value investing lens, it suddenly gets, well, pretty fascinating.
It really does. There are surprising opportunities, and you start seeing how fundamental it still is to, well, basically everything in modern life, something that often gets lost in the headlines, I think.
Exactly. It's so easy to just dismiss coal,
Yeah.
right? Just label it dirty energy or an industry that's, fading away.
Mm-hmm. But the sources you gave us really hammer home that this misses a huge distinction, a crucial one, actually, and that can create some serious blind spots if you're trying to get the full picture.
So that's our mission today in this deep dive, right?
Yeah.
To cut through all that noise, get past the sort of surface level takes, and really extract the key insights about one specific company, Warrior Met Coal. Ticker is HCC.
That's the one. And it operates purely in the metallurgical coal space, which is key.
Yeah, and the initial intrigue, for me anyway, is just how counterintuitive this whole thing feels. Talking about investing in coal now, today, with everything going on with green energy and, ESG pressure.
It feels wrong somehow, doesn't it?
It does. But these sources show that some really smart, well-known investors, disciplined folks, aren't just looking. They're taking big positions. Real conviction.
Significant stakes, yeah.
So this deep dive, for you listening, it isn't just about Warrior Met Coal, though it's a great case study. It's really about practicing that critical thinking in a world that just throws information at you constantly.
Trying to see past the easy narrative.
Exactly. Helping you see beyond those first impressions and figure out where real, maybe hidden value might actually be hiding. So, okay, let's get into it. Let's unpack this. Let's do it.
So let's kick off with what seems like a really basic question, but I bet a lot of people might stumble on it. What exactly is coal? And why are we even talking about it in, 2025, when everything seems focused on phasing it out?
Yeah, the common idea, like you said, is it's just this dirty fuel, a relic used for power plants.
Right. But the sources, they draw a really, really sharp line here, a distinction that changes everything for this discussion.
It's a fantastic place to start because you're spot on. The word coal itself just carries so much baggage, so many assumptions. Fundamentally, the sources make it crystal clear. There are two main types, and getting this difference is absolutely essential for everything else we'll talk about.
Okay.
First, you've got thermal coal. Now, this is the stuff most people think of. It's mainly for energy. Historically, steamships, trains. Now, its big use globally is in power plants, generating electricity.
Right. The one everyone talks about shutting down for climate reasons. Yeah. Exactly. That's the coal that's squarely in the crosshairs, and for good reason, in environmental debates about cutting power grid emissions.
Okay, so that's thermal coal.
Yeah.
Power. Got it. Then what's the other one? The one Warrior Met Coal deals with? This is where it gets different, right?
Totally different. This is the second type, and it's our entire focus today. Metallurgical coal. You'll often hear it called met coal or coking coal.
Coking coal, right.
And it's fundamentally different. Different composition, different use. Its only real specialized use is in making steel. Specifically, it's used to produce something called coke.
Coke, like the drink.
No, not quite. It's a processed form of coal baked at high temperatures, and that coke is an absolutely essential, basically irreplaceable ingredient for making iron and steel in traditional blast furnaces.
Okay. So it's an ingredient for steel, not a fuel for general power.
Precisely. And this is critical, worth repeating. Warrior Met Coal, HCC, is a pure-play metallurgical coal company. They mine zero thermal coal, none. Their product is a premium, high-quality met coal, specifically something called hard coking coal, or HCC. We can get into the quality details later, but the point is...
About powering lights.
No, it's about building things. Building the actual physical world we live in.
Okay, so just to make sure I'm getting this right for everyone listening, when we talk Warrior Met Coal, we are not talking about keeping your house warm or powering the grid in the usual sense.
Absolutely not.
We're talking about the basic building blocks of, well, everything.
Yeah.
Building cities, making cars, those huge bridges, maybe even the steel needed for wind turbines or EV charging stations. Is that right? It's the backbone.
That's an excellent way to put it. It's the backbone. Steel, which overwhelmingly depends on met coal, is indispensable. You can't have economic growth. You can't have development without it. The sources hammer this home.
The scale must be huge.
Oh, it's staggering. Globally, we use, on average, over 1.8 billion metric tons of crude steel every single year.
Billion with a B.
Billion with a B. And where does it go? It's everywhere.
Yeah.
About 52%, over half, goes into building and infrastructure. Think skyscrapers, bridges, roads, foundations, everything.
Okay.
Another 16% is for mechanical equipment, the machines that run factories, industry. 12% goes into cars and trucks. 10% for other metal products. 5% for transport, like ships and trains. 3% for electrical equipment. Even 2% for your washing machine and fridge, domestic appliances.
So literally from my washing machine to the Golden Gate Bridge, it's all reliant on steel, which means it's reliant on met coal.
Pretty much, yeah. It's kind of invisible in daily life, but it's utterly essential.
And the sources suggest this isn't going away anytime soon, even with all the changes happening.
No, the sources are really quite clear. It's highly probable we'll be relying on met coal for steel well into the middle of this century. Maybe longer. It's just fundamental for growth, especially for less developed countries still building out their infrastructure, their cities, their manufacturing.
Like places like India, Southeast Asia.
Exactly. They need vast amounts of steel for manufacturing, construction, infrastructure like ports and railways, transport, even energy grids.
Yeah.
And here's the kicker, the uncomfortable truth for some.
The green angle.
Yeah. Even for a quote-unquote low-carbon world, steel is unavoidable. Electric vehicles need tons of high-strength steel. Renewable energy, those giant wind turbine towers, steel. Solar panel frames, steel. EV charging networks, steel. New bridges for smart cities, steel.
So the demand isn't just stable. In some critical areas needed for the green transition, it's actually growing.
That's the paradox. The demand seems incredibly robust.
Okay. So, point taken. Not all coal is the same. Met coal is essential for steel. Steel is essential for everything, including the future, and demand looks strong. Now let's zoom in on Warrior Met Coal itself.
Yeah.
What makes this company stand out in this very specific, very vital niche? What's their edge?
Right. So Warrior has several key advantages that the sources really highlight. First, just their core business. They are a top producer and exporter of really high-quality met coal, specifically that hard coking coal, HCC.
HCC, right.
And this stuff is known globally for making blast furnaces run more efficiently, less energy needed per ton of steel, and crucially these days, it results in lower emissions compared to using lower quality coals.
So it's cleaner in a relative sense within that process.
Relatively speaking, yes. And their specific HCC has very low sulfur and great coking properties. Steelmakers love it. It's a premium feed. And this quality shows up in the price. They typically get around 98% of the benchmark index price.
90%. That's really high for a commodity, isn't it?
Yeah.
They're getting basically top dollar because the quality is so good. That's a huge edge.
It's a massive edge, and their operations are set up to support this. They're based in Alabama, have 2 underground mines running mine number 4 and mine number 7. And importantly, their big new project, Blue Creek, is right there too.
All close together.
Yeah, really close. And that's a big strategic plus. It means they can use one single logistics network. Everything streamlined: transport, maintenance, people, much more efficient.
Okay, so that concentrated footprint, plus being in Alabama,
Yeah.
that sounds like it helps get the coal to customers efficiently. Tell me more about those geographic and logistical pluses.
Definitely. So their mines are only about 300 miles from the port of Mobile, Alabama, a deep water port. They use trains, mostly, to get it there. Super efficient rail links. And once it's loaded onto the buyer's ship or barge at the port, Warrior's job is done.
So they don't have to worry about the ocean voyage.
Nope. That close proximity to the port cuts their inland transport costs and time way down. Very lean supply chain. And this gives them that seaborne coal advantage. Think of it like you want to sell your product globally, not just locally.
Right. More potential buyers.
Exactly. By shipping mainly by sea, they get huge flexibility. If demand dips in, say, Europe, they can pivot and sell more to India or Brazil. Diversifies the risk, keeps the demand flowing, unlike companies stuck selling only within their own country.
That makes sense. Seaborne is more global, more resilient.
And global demand for seaborne met coal is expected to stay strong for that very reason. Now here's a really big one. Transit time. It takes about 2 weeks to ship coal from Alabama to Europe.
Okay.
From Australia, the world's biggest exporter. It takes about 5 weeks.
Whoa. 3 weeks difference. That's huge for inventory and planning.
Massive. It means lower costs and more flexibility for their European customers. It makes Warrior a very attractive supplier.
That transit time alone is a killer advantage. And I guess all this efficiency flows through to their production cost, too. Are they a low-cost producer?
Oh, yeah, absolutely. That's one of their hallmarks. They are consistently in the lowest quartile globally for production cost.
Lowest quartile. How do they manage that?
It's not just luck, it's a combination of things. They use efficient longwall mining, it's safer, gets more coal out, higher productivity than other methods. They have their own preparation plant in-house to process the coal, and a super efficient conveyor to rail system. They control the whole chain from the mine face to the train.
So dig it out efficiently, process it themselves, move it smoothly to the port. Sounds like a well-oiled machine.
It really is, and they've got this clever variable cost structure, too. Their royalty payments, for example, are tied to the price they actually get for the coal.
Ah, so if prices fall.
Their costs fall, too, automatically. It significantly reduces their cash costs when prices dip. This helped them stay free cash flow positive even during that really severe downturn when COVID first hit.
That built-in flexibility must be critical in a cyclical business like coal.
It's huge for resilience and long-term profitability.
Okay, this is where it gets really interesting for me. All this efficiency, these advantages, the cost structure. How did that actually play out in their recent financials? Because, the global economy, commodity prices,
Yeah.
it's been a wild ride.
It really has. And their Q1 2025 results give us a perfect snapshot of how they handled that volatility. Let's compare Q1 25 to Q1 24.
Okay.
Production-wise, they actually produced more coal in Q1 25, about 2.25 million short tons, up 10% from the year before.
Up 10%. That's pretty good.
Yeah, and sales volume was up slightly too, about 2% at 2.17 million short tons. And that production increase is mostly because they started getting some initial tons out of the new Blue Creek project.
Ah, so the growth engine is starting to sputter to life, even if just a little bit.
Exactly, an early positive sign.
Okay, producing more, selling a bit more, sounds good. But what about the price they got? Because prices have come down a lot, haven't they? How did that hit revenue and profit?
Yeah, this is where you really see the cycle bite. Their average selling price dropped a lot, down 42%, from around $234 per ton in Q1 24 to about $136 in Q1 25.
Ouch, 42%.
Yeah, and that flows right to the top line. Revenue fell 40% from over $500 million down to about $300 million.
Wow.
And the bottom line swung pretty dramatically. They went from making $137 million in net income in Q1 24 to an $8.2 million loss in Q1 25.
A net loss,
Right.
okay, and cash flow, especially with Blue Creek spending.
Negative. Free cash flow went from slightly positive $2.4 million to negative $68.4 million. So yeah, lower prices plus the heavy spending on Blue Creek really showed up there.
That definitely shows the pressure of the cycle on the investment phase. But what about that cost efficiency you mentioned?
Right.
Did it hold up when things got tough? Could they control their spending?
They absolutely did, and this is really key. It shows strong management. Even with revenue crashing, their actual cash cost of sales per ton decreased by 16%.
Decreased.
Down to about $112 per ton from $133 the year before. So they managed to tighten their belts operationally even as the market price fell, controlling the controllables. That's what good operators do.
Okay, so they manage costs really well, even in a tough quarter. What do their margins look like now compared to, say, the peak in 2022 when prices were sky high?
Well, for the period leading into Q1 25, the quarter with a net loss, their gross margin was about 31%, operating margin 16.7%, net margin 16.4%. Now, those are still decent numbers for a commodity producer, especially one investing heavily.
Right.
But context is key. Back in 2022, when prices were crazy high, their gross margin peaked at almost 58%.
58%. Okay, big difference.
Huge difference. So yeah, they're still profitable operationally, managing costs well, but the lower prices and the big Blue Creek spend have definitely compressed those margins from the peak levels. It just underscores how cyclical this industry is. Price drives so much.
Okay, so the recent numbers definitely highlight the cycle, but also Warrior's ability to manage costs through it. But let's look forward now. The sources just keep coming back to this Blue Creek project. They call it a game changer, the growth engine. Let's unpack that. What is Blue Creek and why is it supposedly so important?
Blue Creek is, without doubt, the single biggest thing for Warrior's future. It's a massive project. The backstory is interesting. They actually got the lease for this undeveloped, high-quality coal deposit back in 2016 when they bought the assets of the old bankrupt company, Walter Energy.
Ah, so it came out of that bankruptcy deal.
Yeah, they had plans around 2020, but then COVID hit, prices tanked, so they smartly paused it, put it on hold.
Makes sense.
Then, when met coal prices boomed again, they restarted development in 2022, deciding to fund it themselves.
So they've been sitting on this potential gem, waiting for the right time, and now they're building it out. What kind of growth are we talking? How much does this increase their production?
It's transformative. The sources call it one of the last great undeveloped met coal reserves in the U.S. Just the first phase, a single longwall operation, is expected to boost Warrior's total production capacity by about 60%.
60%.
From one mine.
Yeah. Taking them from roughly 8 million tons a year now up to around 12 million tons a year. And get this.
Yeah.
There's potential to add a second longwall later. That could basically double their current production, take them up towards 17, 18 million tons per year eventually.
No, doubling capacity.
Just the first longwall at Blue Creek is expected to pump out an average of 4.8 million tons a year of premium high-volume met coal for its first decade. That's a huge chunk of new high-quality supply.
Okay, massive increase in volume. And this new mine, I assume it's using modern tech. Will it help their cost position even more?
Oh, absolutely. It makes it even better. Blue Creek's projected cash cost is expected to be around $70 per ton.
70, compared to their current average of 80-something. Exactly. Significantly lower. This just solidifies their spot as one of the world's lowest cost producers, gives them an even bigger cushion in downturns. Plus, using state-of-the-art equipment should mean lower maintenance costs down the road, too. More cash freed up.
Lower costs and way more tons. That sounds amazing. But hang on, a project this big, nearly $1 billion, right? In an industry where banks are getting shy about coal, how on earth are they paying for this without drowning in debt? That would normally be a huge red flag.
And that's where Warrior's discipline really stands out. It's a huge point in the sources. Blue Creek is being fully funded with internal cash.
Internal cash. No new debt. No selling new shares.
None. Their mantra is no new debt, no dilution. They've already spent about $772 million of the roughly $1 billion total cost. The rest will be spent mainly in 2025 and 2026.
Oh, where did they get that cash?
From the massive free cash flow they generated during the last price boom. They piled up cash and are now reinvesting it directly into this high-return project instead of borrowing or diluting shareholders. It avoids interest payments and keeps existing shareholders' stakes intact. It's really impressive financial management in this sector.
It is impressive discipline. So if they're pouring that much internal cash in, the projected returns must be astronomical. What do the sources say Blue Creek will deliver once it's running full tilt?
Phenomenal is the word used often. Just look at the numbers projected post-completion. The net present value, NPV, estimated at $5.4 billion after tax, real terms.
$5.4 billion.
Yep. And that's a $4.4 billion increase over what they estimated before. It's a staggering jump in projected value.
Wow.
Per share, the NPV is projected at over $102. That's up $84 per share from earlier estimates. Just shows the scale of value creation here.
And the rate of return.
The internal rate of return, IRR, estimated at 35%. Real after tax. Sources describe that as private equity level return potential. You just don't see that often in public mining projects.
35% IRR.
Yeah.
Yeah, that's huge. And how quickly do they expect to get their money back? The payback period.
2.3 years from when the longwall starts producing. They recoup that massive investment incredibly quickly.
Okay, those are seriously compelling numbers.
Yeah.
A 35% IRR, quick payback. What does this mean for their actual cash generation long term? Once Blue Creek is humming along, what kind of cash machine could this company become?
At full production, realistically, Warrior could be generating $500 million in free cash flow every year.
$500 million.
Yeah. And for you, the listener thinking about valuation, that translates to maybe a 20% free cash flow yield on their current market cap by 2027 or 2028.
A 20% yield. That implies significant upside from here.
Exactly. The sources suggest potential for a 2x, maybe even 3x return from current levels, purely based on that future cash flow. It's not just growth. It's potentially transformative for their financial profile.
And is it on track? What's the timeline?
Everything seems to be proceeding on schedule and on budget, which is crucial for a project this big. Continuous miner work started late 2024. The prep plant should start mid-2025. That's when we'll see the first Blue Creek coal sales. And the main event, the longwall startup, is expected by Q2 2026 at the latest.
So it's happening now with the big impact coming in the next couple of years. Disciplined, large-scale growth moving towards realization.
That's the picture, yes.
Okay, so Warrior clearly has this powerful internal story. Blue Creek growth, Low costs, strong finances. That's compelling for any company.
Yeah.
But what about the wider world? Is the demand for met coal really going to hold up long term? Or is the world truly moving away from all coal, which could eventually sink even the best operator?
That's the million-dollar question, isn't it? The bigger picture. And this is where it gets really complex and honestly counterintuitive. The sources really dig into global supply and demand for met coal, and they paint a picture of surprisingly robust demand.
Okay, like what?
First, look at India. India is industrializing, urbanizing, building tons of new steel capacity. They are projected to be the key driver of met coal demand going forward.
The main driver.
Yeah. Some analysts project India's demand for seaborne coking coal will grow 50% by 2035. 50%.
Wow.
Their rising steel production is basically expected to offset any potential slowdown in China as its economy matures. And it's happening now. India's met coal imports hit a 6-year high in the first half of 2024. The demand surge is real.
So the narrative of declining global steel might be wrong. It's just shifting location.
Pretty much. Overall, global crude steel production is still expected to grow, maybe 2.5% a year through 2030. Total steel demand projected up 11% by 2030. It's driven by infrastructure, industry development, especially as more people in India, Southeast Asia move to cities. That requires a lot of new steel.
And you mentioned earlier that even the green transition needs steel. Can you elaborate on that ESG paradox? It really messes with the simple narrative.
It absolutely does. Sources call it the ESG paradox or the green paradox. Even if we go full speed ahead on renewables and EVs, guess what? You need massive amounts of steel to build it all.
Right, the turbines, the solar farms.
Exactly. Wind turbine towers are huge steel structures, solar panel frames, components, EV charging networks spreading everywhere, high-speed rail, new bridges, all need tons and tons of steel. So, weirdly, the push to decarbonize actually creates sustained, maybe even growing, demand for the key ingredient in traditional steelmaking met coal.
So building a greener world currently requires a brown input. That is a paradox.
It's an uncomfortable reality, yeah.
Okay, so demand looks strong even from unexpected places. But despite that, the sources say there's massive underinvestment in new met coal mines. Why? If the demand's there, why isn't supply keeping up?
Now we get to the supply side constraints. And this is where ESG pressure really bites hard, creating a major bottleneck. As one source said, coal is a 4-letter word.
Yeah, the perception is terrible.
Terrible. And because of that intense environmental, social, governance pressure, banks, insurers, big financial institutions, they're getting really hesitant, sometimes flat out refusing to back new met coal projects.
So it's hard to get loans. Insurance.
Incredibly hard. Even just basic banking relationships can be a challenge. One source mentioned a 150-year-old thermal coal company, perfect financials, never borrowed money, got dropped by JP Morgan Chase just because they were coal. Couldn't even get workers' comp insurance easily.
Wow. So it's not just about funding new mines. It's the whole financial ecosystem becoming hostile.
Totally. And that drives up financing costs for those who can get funding.
Yeah.
In Australia, for example, a lot of coal funding now comes from private debt, which is way more expensive than bank loans. That makes new projects less profitable, less attractive to build, which restricts supply even more.
So fewer new mines are getting built.
Very few. Estimates suggest only maybe 3 significant new met coal projects are happening in the U.S. Blue Creek is easily the biggest. Canada might add a bit, but a lot of that is just extending the life of old mines, not adding brand new capacity.
Okay, so strong demand meets constrained supply. What's the prediction?
A widening gap, a significant deficit. One projection shows a 28 million ton shortfall in seaborne coking coal by 2035. And demand forecasts keep getting revised upwards, so that deficit could be bigger or arrive sooner.
So the ESG push, while aimed at climate, is ironically creating a supply crunch for a material needed for development and for the green transition itself.
That's the complex reality the sources point to, a potential pinch point for the global economy.
Right. Supply tight, demand strong, but the ultimate question remains, can we just make steel without coal? Are there viable alternatives that could kill demand long-term, no matter the current dynamics?
The critical long-term question, yeah. And the sources look closely at the alternatives and their current limits. Method number 1, the big one, is the basic oxygen furnace, BOF. That's 70–75% of global steel.
Okay.
That's the traditional way, relies heavily on coke from met coal. It's the cheapest way to make steel, around $390 a ton, but it emits the most CO2, about 2.3 tons of CO2 per ton of steel, and China. 90% of their massive steel output is BOF. It's deeply entrenched.
Okay, so that's the standard met coal hungry process. What about cleaner alternative?
The main one is the electric arc furnace, EAF. That's maybe 20–25% of global steel. It uses mostly scrap steel. Much cleaner, only emits about 0.67 tons of CO2 per ton. Big environmental plus.
Okay, EAF sounds better. Why isn't everyone using it then?
Big challenges. First, scrap. Where do you get enough? Steel lasts a long time, average 40 years, so there's a lag getting scrap back. Demand for new steel today outstrips scrap supply. Basically, all the scrap we collect is already being recycled. Any growth in steel demand has to come from new iron, which needs met coal.
So we can't just recycle our way out of needing new steel.
Not at current growth rates. Plus, scrap quality can be an issue. Impurities, contamination, harder to make high-grade steel sometimes.
Okay, scrap availability and quality are hurdles. Anything else for EAF?
Scale. An average EAF makes maybe 1.5 million tons a year. A big BOF blast furnace can make up to 4 million tons. For developing countries needing huge volumes quickly, switching entirely to smaller EAFs would actually cut their output capacity and raise costs.
Right, scale matters.
And infrastructure. Many places lack the setup to efficiently collect and transport scrap or handle the massive electricity needs of EAFs.
Got it. So EAF is cleaner but limited by scrap, scale, and infrastructure. What about the really green option using hydrogen? Direct reduction.
That's direct reduced iron, DRI, often paired with an EAF. Tiny slice right now, maybe 5% of global production. It uses gas, usually natural gas, but the dream is green hydrogen.
Green hydrogen, right. Lowest emissions.
Potentially, yes. If you use green hydrogen, DRI EAF is the cleanest route. And it's a big but making green hydrogen at the scale needed for the steel industry, it's currently nowhere near cost effective. And it's the most expensive conventional way to make steel right now, about $455 a ton versus $390 for BOF.
So technologically possible, the future ambition, but just not practical or affordable at scale today.
Exactly. The takeaway from the sources is clear. Alternatives are evolving, research is happening fast, but met coal is going to be incredibly hard to replace for decades. Scrap issues, quality, scale, cost, green hydrogen limitations. It all means BOF steelmaking, and therefore met coal, remains essential for the foreseeable future. Especially with global steel demand still growing. It's just the pragmatic reality.
Okay, that makes a lot of sense. So let's zoom back to Warrior Met Coal itself again. Given this complex market, how solid is their financial health? Are these investments paying off on the balance sheet? And what are guys like Mohnish Pabrai seeing that makes them so confident?
Warrior's financials look remarkably strong. The sources describe the balance sheet as lean, liquid, and battle-ready. Like a fortress.
A fortress balance sheet. How so?
Well, look at their debt. Their operating cash flow is more than twice their total debt. Now, that ratio came down a bit recently with the Blue Creek stunting and lower prices, but it still shows they are nowhere near over-leveraged. They generate plenty of cash to cover debt and fund growth.
Okay, not drowning in debt, which is good for a miner, building a huge project.
Exactly. And their interest coverage, it's insane. 97.1 times.
97 times.
Yeah. It signals basically zero risk of defaulting on interest payments. Most companies are happy with 3x or 4x coverage. They have almost 100x. It's incredibly safe from that perspective.
Wow.
Plus, they have minimal leverage overall. Huge cash pile, over $450 million cash as of March 31st, 2025. That means they actually have negative net debt of over $330 million. Their debt-equity ratio is tiny, 0.1. And importantly for value folks, no goodwill or intangibles cluttering up the balance sheet. It's all real assets.
So ton to cash, almost no net debt. That gives them huge flexibility, right, to weather storms or delays.
Huge flexibility. They can ride out tough prices, project delays, whatever, without needing to run to the market for cash. Very resilient.
Okay, solid foundation. What about returns? Are they actually making good money on the capital they're putting back into business?
Yeah.
ROIC, ROE.
Yeah, their 5-year average numbers are really impressive for a capital-heavy business. ROIC averages almost 33%, ROE over 27%, ROA nearly 19%.
Those are high numbers for mining.
Exceptionally high. They blow past a typical 10% cost of capital hurdle easily. It proves their assets aren't just generating cash, they're compounding it effectively, even after prices come off the boil. That low-cost structure really helps lock in decent returns through the cycle.
And the management team. Who's running this ship? Are they any good? Disciplined? Because that matters hugely in value investing.
Sources paint a very positive picture here. Experienced, battle-tested is a term used. They've navigated crashes, booms, bankruptcies before in previous roles. The CEO, Walter Scheller, has over 40 years in mining. The CFO, COO also have deep expertise.
So veterans who've seen it all, do they have skin in the game? Is their own money on the line?
Yes, significant insider ownership. CEO Scheller owns almost 0.8%, worth over $20 million. Others have meaningful stakes too. That aligns their interests directly with shareholders. They think like owners.
That's always good to see. And their capital discipline. You mentioned funding Blue Creek internally.
Yeah, that's the prime example. Avoiding debt, avoiding dilution. They prioritize self-funding, strong balance sheets, smart reinvestment. They also raised dividends, paid a special dividend in 2023 when cash was flooding in, and retired nearly half their secured debt. They manage for the long haul and return cash smartly when appropriate. Very disciplined.
Okay, so strong balance sheet, great returns, experienced management with skin in the game, huge growth project.
Yeah.
It sounds amazing. So why the disconnect in the valuation? Why isn't the stock price higher if the story is this good?
That's the million-dollar question and the core of the deep value argument. Look at the valuation metrics. Trailing PC is around 10, but the forward PE jumps to 25. Same with EBITDA. Trailing is 5.4, forward is 7.6.
So the market expects earnings to fall sharply.
That's what it suggests, yeah. The market seems to be pricing in continued softer met coal prices, the current high spending on Blue Creek, and, crucially, no immediate big volume boost from the new mine because it's still ramping up.
So basically the market is looking at the next few quarters, not the huge potential payoff from Blue Creek in a couple of years.
That seems to be the case. Based on conservative DCF models and the sources, Warrior is potentially trading at something like a 34% discount to its intrinsic value. That discount implies the stock already reflects a pretty negative view on near-term prices and cash flow.
The value is there, but maybe not obvious yet.
Exactly. As one source put it, the value is real, but not obvious, because the full impact of Blue Creek is still 12, maybe 24 months out. It takes patience to see it.
And this sounds like exactly the kind of situation deep value investors like Mohnish Pabrai love, right?
Yeah.
Where the market is focused short-term and missing the long-term picture.
Precisely. Pabrai, famous for his concentrated bets, has put a massive 37% of his U.S. portfolio into HCC. That's huge conviction. It signals he sees tremendous deep value potential and a big margin of safety.
37%, wow.
Yeah. He had that quote, maybe exaggerating slightly for effect, about buying companies making $1 billion a year for 50 years for cheap. While not literally true for Warrior, it captures the kind of long-term cash flow machine potential he sees in these underappreciated producers. Another investor mentioned, Blake Downer, also talked about wanting to dollar-cost average in, seeing the long-term compounding potential.
That's serious belief from serious investors.
Yeah.
How has Warrior actually done for shareholders compared to peers, though? What do the returns look like?
Well, since mid-2020, HCC has returned over 328%. That's a compound annual growth rate of nearly 34%, easily beating the market.
That's fantastic.
It is. But if you compare it to, say, Alpha Metallurgical Resources, which went up over 3,000% in the last cycle.
3,000%. Okay, why the difference?
Or Canadian Natural Resources, up over 900%. Warrior's return looks more modest in comparison. But the key reason is that Warrior was pouring its cash into building Blue Creek, reinvesting for future growth. Those other guys, they were doing massive share buybacks, special dividends returning cash now.
So Warrior was building for the next cycle, while others were maybe maximizing returns from the last cycle. That's the argument. The real test, the big potential upside for Warrior, is expected after 2026 when Blue Creek is fully ramped up. They're playing a longer game.
Okay, that makes sense. But look, every investment, no matter how good the story sounds, has risks, especially a cyclical commodity business like coal. What are the big hurdles Warrior faces? What should someone really keep an eye on if they're looking at this?
Absolutely critical to understand the risks.
Yeah.
Number one, unavoidable, is commodity price volatility. Warrior makes money based on steel demand and met coal prices. Those can swing wildly with the global economy, geopolitics, trade fights.
Right. We saw that in the Q1 numbers. Margins can shrink fast.
Exactly. Even as a low-cost leader, they can't control the market price. That's always the biggest external risk.
Okay, price risk. What about internal operational risks? Labor relations. A big chunk of their workforce is unionized. They had that long, painful strike back in 2021, 2022. It showed how disruptions and cost hikes can happen if labor relations sour. They have a contract now, but it's always a potential flashpoint in mining.
Yeah, union dynamics can be tricky. And then there's just the whole coal label itself, right? The ESG pressure.
Definitely. Regulatory and environmental pressures, ESG, are a constant factor. Stricter emissions rules, changing investor demands, problems getting permits. These could slow things down or add costs long term. And just the label coal brings headline risk, makes financing harder, insurance harder, as we discussed.
So even if they're doing met coal, not thermal, they still face that broad anti-coal sentiment.
Yes. It creates supply constraints for the industry, which can be good for prices, but
Yeah.
it's also a direct risk for the company itself in accessing capital markets and services.
What about Blue Creek itself? It's so central to the thesis. Is there risk there?
Huge risk. Execution risk at Blue Creek is probably the biggest internal risk. It's a massive, complex, billion-dollar project. Even though it's on track now, any big delays, cost overruns, technical problems that could seriously hurt future output and the expected returns. Getting Blue Creek built and running smoothly is absolutely critical.
Okay, project execution is key. What about their customers? Are they too reliant on just a few big buyers?
That's a fair point. Concentrated market exposure. Like many specialized producers, they do rely heavily on a few major customers, mainly in Europe, Brazil, Asia. That seaborne flexibility helps them pivot, but a big slowdown or contract issue in one of those key regions could still hurt revenue significantly. It's a risk they manage.
And geopolitics, we just saw those new U.S. steel tariffs. Does stuff like that impact Warrior?
Potentially, yes. Geopolitical and trade policies are another risk factor, those 50% U.S. steel tariffs. While the impact isn't totally clear yet, it could raise U.S. steel prices, maybe lowering U.S. steel demand, which means less demand for Warrior's coal from U.S. mills.
But couldn't it also push steel production elsewhere? Maybe to Europe, where Warrior sells.
Possibly. It might lower European steel prices if supply gets diverted there from the U.S. The company itself said it's hard to predict the exact impact right now. It just adds uncertainty. It's something to watch, even if it's maybe more short-term noise.
Okay. And finally, those alternative steel methods, EAF, DRI. Even if they're limited now, could a breakthrough pose a long-term threat?
It's the long-term horizon risk, absolutely. A sudden shift, maybe driven by heavy carbon taxes on BOF steel, or a real game changer in green hydrogen cost and scale, or scrap processing could eventually erode met coal demand. It's not immediate, sources agree on that, but it's the direction technology and policy are pushing. It's a tail risk the industry has to watch.
So wrapping this all up, after digging into all these complexities, the hidden details, the surprising opportunities in an industry most people write off, what's the bottom line for you, the listener? It's way more complicated than just coal bad, isn't it?
Oh, absolutely. What emerges from the sources isn't just a coal company. It's framed as a low-cost cash machine with hidden upside, a high-conviction compounder in a mispriced wrapper.
Strong words.
Yeah. The idea is the market sees a volatile commodity business, but the deep value view sees this incredibly well-run operation that takes that volatile input, met coal, and turns it into pretty consistent profits in cash because of their cost leadership. Enough cash to fund massive growth like Blue Creek entirely internally. That's rare.
So it's less a bet on coal prices always going up and more a bet on operational excellence and smart capital allocation compounding value over time.
That's exactly the thesis. It's a bet on discipline, cost leadership, and smart reinvestment. And the market, maybe focused on the short term, doesn't seem to fully appreciate the future value explosion from Blue Creek yet.
Which creates that margin of safety.
Exactly, a buffer if things go wrong, and huge upside if Blue Creek delivers as expected. Yes, it's cyclical. You might need patience for the next upswing, but their low costs provide resilience. It really fits that classic value investing asymmetry. Heads, I win big. Tails, I don't lose that much. A compelling risk-reward, according to these sources.
That is a lot to think about. It definitely challenges the easy narrative, doesn't it? Makes you look way beyond the headlines and dig into the fundamentals.
That's the whole point of the deep dive, right?
Absolutely. So here's a final thought for you, our listener, to chew on after all this. We've seen how essential steel is, how demand keeps growing globally, yet the supply of its key ingredient, met coal, is getting squeezed by things like ESG pressure. So the provocative question is, what other essential industries or commodities might be out there right now, quietly poised for a comeback or revaluation, much like met coal, simply because they're absolutely necessary but maybe currently out of favor, misunderstood, or facing their own weird paradoxes? Keep digging, keep questioning, and keep diving deep.